Today, we're digging into a company that has been absolutely on fire, Acutaas Chemicals. Now, on the surface, this thing looks like a total powerhouse, but we're going to go under the hood to see what's really driving this thing. So, let's just start with one number, 35.2%. What is that? That's the average profit growth this company has cranked out every single year for the last 5 years. I mean, that's not just good, it's pretty incredible. Right off the bat, you know we're dealing with a serious performer.
And that leads us to the big question, doesn't it? The growth is clearly there, but the stock comes with a pretty hefty price tag. So we have to ask, is the hype real? Is this company actually worth the money, or is the market just getting a little too excited?
Okay, first things first. To really get a handle on Acutaas, you have to understand the world it lives in. It's riding a massive industry wave right now, and we need to see why.
And look, we're not talking about small trends here. These are huge global shifts. The big one everyone talks about is the China Plus One strategy, where global companies are desperately looking for manufacturing partners outside of China. You combine that with a booming demand for these complex chemicals, and you've got a massive tailwind for the entire Indian chemical sector.
But it's not a completely open road. This slide really captures the core tension here. The opportunity for India is absolutely massive, but the threat is just as real. Those huge Chinese manufacturers, they aren't going anywhere, and they still compete like crazy on price. So to win, you have to be really, really good.
So if the whole industry is getting this lift, what's so special about Acutaas? How is this particular company built to not just ride the wave, but to lead the pack? Let's break down their growth engine.
A huge piece of the puzzle is right here in where their money comes from. A whopping 65% of their business is from making pharmaceutical intermediates. Think of these as the essential, high-tech building blocks for making drugs. This isn't some cheap commodity business. We're talking about a high-value, highly specialized game.
And that focus on high-value stuff, well, it shows up right here in the profits. This chart shows us their return on capital employed, or ROCE. It's basically a measure of how good a company is at making money from the money it invests. For every dollar Acutaas puts in, it generates 22.5 cents of profit. That completely blows away the sector average of just over 14 cents. They're just flat out more efficient than their competitors.
And they are not slowing down. They've got this super clear 3-part plan to keep the growth coming. First, they're going on a building spree to literally double their production capacity. Second, they're keeping the innovation going, with plans to launch another 8 to 10 new high-value products. And third, they're expanding their footprint, pushing into new markets. This is a company on the attack.
So how do they protect all this profitable business? Well, investors love to talk about a moat, and Acutaas has a pretty good one. For them, it's about being deeply embedded with their pharma clients. Because of all the regulations, these clients can't just switch to a new supplier overnight. Plus, Acutaas has its own specialized tech that's tough to copy. It makes their business really sticky.
And here's another key part of that moat: backward integration. What on earth is that? It just means that instead of buying all their key raw materials from other companies, they make a lot of them themselves. They are at a 70% integration level. That gives them incredible control over their supply chain, protects them from price swings, and gives them a huge cost advantage.
All right, so far it all sounds pretty amazing, right? But hold on. A good analysis means looking at both sides of the coin. No company is perfect, so now we have to go looking for the potential cracks in the armor. What are the risks here?
And there are definitely some real concerns. The big one, and you hear this a lot, is that high valuation. If the company has even one bad quarter, a stock price for perfection can get hammered. It's also a business that eats up a lot of cash, it's exposed to swings in raw material costs, and it's tied to the ups and downs of the pharma industry. These are all things to keep an eye on. Let's put a number to that valuation concern. The company trades at 29.3 times its earnings. This is its price-to-earnings ratio, or PE, which is how we often measure how expensive a stock is. So what does a PE of 29.3 really mean? It means the market already expects fantastic things from this company. All that great future growth we talked about, it's already baked into the stock price. And that's the risk, right? There is zero room for error. Good news is priced in, which means any bad news could be a big problem. Okay, so we've got a powerful growth story on one hand and a pretty significant valuation risk on the other. It's time to weigh all the evidence. Let's get to the verdict. What is this company actually worth?
And this table, this is where it gets really interesting. Look at that PE ratio for Acutaas. It's 29.3, which is right in line with the sector average. But then look at its growth and its profitability. They are significantly better than its peers. This really gets to the core of the argument. You're paying an average price for what looks like a well above average company.
So, what do the models say? The base case, which is basically the most likely scenario, assumes they keep growing at a strong 22% a year. That model spits out a fair value of 1,350 rupees per share. From where it's trading now, that's a modest upside of about 8.4%.
But what if everything goes perfectly? In the bull case scenario, if they execute flawlessly and really accelerate that growth to 28%, the target price jumps to 1,650 rupees. Now you're talking about a potential upside of over 32%. This is the scenario that gets growth investors really excited.
Of course, we have to look at the flip side. In the bear case, if competition heats up and growth slows down to just 15%, the valuation could drop all the way to 950 rupees a share. That's a potential drop of almost 24%. It's a stark reminder of the risk that comes with that high starting price.
Now let's wrap this all up with the final scorecard from the report. The overall score is a really strong 8.2 out of 10. And just look at the scores for financial health and growth prospects. They're fantastic. But then your eye goes down to valuation, a 7.2. It's still a good score, but it's clearly the weak link. And that really tells the whole story, doesn't it? Fantastic company, but you're going to have to pay up for it.
So after weighing everything, the final call from the report is a buy. The target price lines up with that base case scenario we talked about, 1,350 rupees, suggesting there's still a reasonable, even if not spectacular, upside from here.
And that leaves us with one last big question. The analysis points to a solid company with a decent upside. But we all saw that bull case, right? The potential for over 30% returns. So the real question isn't about today's numbers. It's about tomorrow's execution. Can this management team keep this incredible machine running flawlessly? Because that's what will truly determine the future for Acutaas Chemicals.